Hi everyone, this is Peter with practicaladvice.info. I wanted to show you today a trade that I did on the QQQ product, but not directly on this product. If you are familiar with this Nasdaq tracking ETF, the QQQ, this actually tracks the Nasdaq, and so you don't have to trade the actual futures. There is an ETF product for this. Now, I do not trade generally the the triple Q, the QQQ. I will actually trade this triple leveraged Nasdaq ETF, which is called TQQQ. It's a ProShares product. This thing is leveraged to go up 3 times as much per day as the regular Q product. So it can be a meat grinder. If it goes sideways, you start losing money and you don't even know why you're losing money. So this is not something that's recommended to hold forever. What I have found is when it's going up, it actually outperforms the Qs by about 2 to 2.5 times. So you're not actually getting the 3x leverage. You're actually getting 2 to 2.5 times. Now, I don't know if that's correct for every single stretch, but this is triple weighted, so you can make money, in theory, 3 times as fast, or you can lose money 3 times as fast. Now, what I wanted to mention about this product is there is actually an inverse of the triple weighted Nasdaq tracker, and that is the SQQQ. Now, this product today, it's at $6. Actually, let me zoom out here. You can see here, this particular thing does nothing but lose money. And so if it's always losing money, and it's just always losing money and losing money and losing money, why would you trade it? Well, you might want to short the product. And what happens here, what I find is, and I've gone back a number of times to look at this, it never, even in the crashes, seems to double in value. So if you are shorting this product, when you get to a higher level of value in this, and you actually short it, you have a reasonable chance of it going down over time. So this is actually one of my crash response strategies, which is that I want to be short or write call spreads on this when it is high. If you saw my video on the VIX you have to kind of be early if you want to buy underneath. And then if the VIX has already gone up, let me go back to the VIX here. This is an oscillator. The VIX goes up and down. If you saw my VIX video, you know that the VIX goes up and down. Volatility increases and decreases over time. Well, today, because of the inflation concerns that came out, the significant inflation that just came to be measured, the VIX spiked, and it seems that rates spiked. The rate that I was seeing here on the 10-year yield was up significantly. The dollar was rallying. Perhaps that's because of inflation, or not inflation fears, but economic contraction fears. Whatever the reason, it was a bad day in the markets. The Dow sold off, and the other indexes sold off as well. So the VIX spiked. 1885 is what I'm looking at here, and that's just the active contract. That's not necessarily the stock price. That's just the active contract, which is the 7 days. We're at 1980 on this. 1785 is where we are on the VIX for expiration. So this is an oscillator, it oscillates, it goes up and it comes back down. But the SQQQ product actually just seems to go down. Over time, if you put your money in this, you would lose 100% of it. And it would get closer and closer and closer to zero. I don't know that it ever will get to zero, but it's going to get closer and closer and closer and closer to zero as time goes by. And you say, well, right here, it looks like it's flat. It doesn't do anything. That's not true. As you keep zooming in, it keeps going down. It just continues to go down forever and ever and ever and ever. So when this thing spikes, there is a benefit to writing call spreads above it. So I wrote a call spread today. I'm showing you the spread. It is a 7 to 9. That does not mean this thing could not go to $40. It certainly could. In the event of a correction, this thing goes up quite a bit. But I only have $200 risk. And for me, this spread here for 37 days, since this is a short of a short product, this makes me a bull. So I am actually bullish because I am shorting a short product. So I'm writing a call spread, which means I want it to go down or stay the same. Staying the same is fine. Stay the same or decrease. But this is already an inverse product, so we do that again, and now I am bullish. So I am expecting on this that this item will in 37 days be less than $7. Will it be? I have no idea. But if it is higher, then that means we have probably a market crash, or at least a pretty sizable correction. And in that case, then I'm going to have opportunities to right above to roll this out, buy it back at a loss of $175 and continue on. So I know a lot of people are not thinking about shorting a short product, but it is possible to short a short product. And in this case, because this thing always goes down over time, when it spikes up, there is an opportunity to go against it. I am much better at choosing it that way than just assuming, oh, it's going to go up now. But this is actually a bullish trade on the Nasdaq. So I am assuming that the Nasdaq will recover in this trade, even though that may not be my assumption. I don't actually know what the Nasdaq is going to do. I think the Nasdaq is under pressure because of tapering, because of rising rates, because we are so over leveraged. The economy is. So I think there are tremendous headwinds for everything. The NVIDIA was selling off, I noticed. AMD was selling off. Pretty much all of the trades that I have been making this past week have been doing well. And so I just wanted to give some perspective here that this product is a way to respond to crashes. So not telling you what to do, as always. This is just a trade that I was making, and hopefully it gives you some food for thought and helps you to round out your own portfolio and have some strategies in the event that a market crashes. What do I do? And in this case, this is something that you can do. So thank you, everyone, and I hope this helps.